When supply looks strong, but prices refuse to collapse, the market is telling you something most investors are missing. The energy markets throughout 2025 delivered surprises that confounded even seasoned investors who thought they understood the geopolitical landscape. What stands out most strikingly is how few supply disruptions actually materialized despite numerous flashpoints that historically would have knocked millions of barrels offline. Wars, sanctions, civil unrest, the usual culprits that tighten markets and send prices soaring, somehow failed to produce their expected impact. Instead, disruptions reached record lows, leaving the market with roughly 1 million barrels per day of surplus concentrated in the second half of the year. OPEC Plus miscalculated their production additions, responding to higher than consensus summer demand by bringing supply online more quickly than prudent. They relied on industry consultants whose forecasts proved inaccurate and now find themselves in an uncomfortable position. The Trump administration's promises regarding Iranian sanctions enforcement echo the unfulfilled commitments of 2018, when oil crashed in the fourth quarter, before enforcement finally materialized the following year. Whether this administration will actually follow through remains uncertain, but the pattern suggests caution about taking political promises at face value. American production continues defying expectations despite declining rig counts, particularly on the natural gas liquid side. Productivity gains have sustained output levels that should have already rolled over based on activity metrics alone. The observable data hasn't yet confirmed the plateau that fundamentals suggest is approaching, though the inflection point appears imminent. What's remarkable is that despite 3 significant bearish factors converging, fewer geopolitical disruptions, faster OPEC additions, and persistent American production, oil only declined $20 rather than $40 or more. The resilience in pricing, despite these headwinds, speaks to underlying tightness that markets are beginning to recognize. The narrative around OPEC pursuing market share battles misreads their actual strategy. They weren't trying to crush competitors through volume wars. They were caught off guard by demand and supply dynamics that didn't materialize as their consultants predicted. The widening gap between official quotas and actual production reveals something fascinating. Countries that once cheated by overproducing now find themselves unable to meet their expanded allowances. Kazakhstan's situation illustrates this perfectly, with their major Chevron-funded expansion now declining alongside base production deterioration. Iraq's overproduction involved complex internal politics regarding Kurdish regions and possibly smuggled Iranian barrels being laundered through Iraqi export channels. What OPEC accomplished this year was essentially a recalibration exercise. By allowing production to run under quotas, they're establishing a new baseline from which future cuts will be far more impactful. This isn't weakness, it's strategic positioning. When they do decide to tighten supply in response to prices that remain unsatisfactory to their fiscal requirements, the reductions will carry substantially more weight than if calculated against the old inflated quotas. Brazil's production story follows a familiar pattern of disappointment interrupted by occasional delivery. They've missed their own forecasts consistently for a decade, creating what analysts call a porcupine chart, where projected output repeatedly exceeds actual results. This year, they finally hit targets as delayed projects came online, but the forward pipeline of new developments is thinning dramatically. Many recently activated projects are already declining, and the floating production units that enabled the 2025 surge represent completed work rather than ongoing capacity expansion. Betting against Brazilian optimism has been profitable 9 years out of 10, and 2026 looks poised to revert to the historical pattern. The major oil companies face similar credibility issues. Exxon has repeatedly missed their production guidance across multiple basins and geographies. Markets periodically get excited about their West Texas operations or various international prospects, only to watch actual delivery fall short of promoted potential. Occasionally, these underperformers will string together a year or two of meeting expectations, creating enthusiasm that proves premature. The aberration was 2025's relative success, and early indicators suggest reversion to historical disappointment is already beginning. What people fundamentally misunderstand is the scale of capital required merely to offset depletion. The International Energy Agency released analysis showing hundreds of billions of dollars must be invested annually just to keep global production flat, before even attempting to grow supply in line with demand. Yet the IEA simultaneously maintains an extraordinary record of forecasting inaccuracy, missing demand projections 17 consecutive years. Banks inexplicably continue using IEA data as inputs for their commodity price models and balance sheets, despite this documented failure rate. Perhaps government connections from the 2008 bailouts create obligations to rely on official sources regardless of their reliability, but the dynamic remains puzzling. American shale faces an inflection that will reshape the entire global supply picture. Since meaningful production growth began around 2010, every major price decline has been explained by either new field discoveries or dramatic per-foot well productivity improvements. The Delaware Basin represented the last significant new discovery, with its peak growth impact hitting in 2018. Nothing comparable has emerged since. The Montney in Canada faces pipeline constraints and regulatory challenges. The oily Utica and Uinta Basin and various other prospects remain comparatively small. The next Delaware Basin simply doesn't exist. Per-foot well productivity peaked around 2020 or 2021, and the industry has compensated by drilling longer laterals. Shell's innovation with U-turn wells, drilling 2 miles out, turning underground, and drilling 2 miles back to complete 4 miles of lateral in a single operation, opened additional economic locations. But even these techniques are reaching their limits. The benefits of going longer are diminishing, with the second derivative turning sharply negative. We're approaching the point where well productivity declines even after accounting for extended laterals and advanced completion techniques. This matters enormously because it triggers what's called the Red Queen effect, where adding rigs no longer adds production due to high decline rates. The United States experienced this dynamic in the 1970s, and shale appears headed toward the same phenomenon. Once well productivity turns negative, operators must drill more just to maintain flat output. As rig counts rise, they're forced into progressively worse locations, creating a vicious cycle where more activity produces less incremental production at higher costs. The economic implications are profound. Peak Permian and peak shale discussions miss the actual dynamic. Production can still grow substantially, but only at much higher prices with far more rigs. Hundreds of thousands of Tier 2 and Tier 3 locations remain that might produce a third the oil in their first year compared to prime acreage. These wells require fundamentally different economics, perhaps double the current price or more to generate acceptable returns. Recent industry analysis cited 37,000 remaining locations in North Dakota's Bakken, but probably 35,000 of those don't generate profits under $100 oil when measured against full-cycle returns necessary to cover overhead and cost of capital. The implications for offshore development are equally significant. As shale productivity deteriorates, deepwater projects that require 5 to 10-year development timelines suddenly become more attractive. The problem is that the investment decisions needed today to produce oil in 2030 or 2032 aren't being made at current price levels. The cycle time mismatch between shale's 6-month response capability and offshore's decade-long development periods creates dangerous gaps in future supply. Despite commodity weakness through most of 2025, energy equities demonstrated remarkable resilience, particularly the major producers. This divergence from historical patterns reflects starting valuations that were extraordinarily depressed. Small-cap oil and gas indices declined 70% over the past decade, while the S&P 500 nearly tripled. Large-cap energy dropped 30%, and even the oil majors barely stayed positive. Meanwhile, junior gold miners, down for most of the decade, surged 300% as gold itself doubled. The gold equity multiple expansion to 5 times the metal's move demonstrates what can happen when sentiment shifts in commodity equities after extended periods of neglect and undervaluation. forward-looking value investors are beginning to recognize the setup in oil and gas mirrors what played out in precious metals. The potential returns for producers and service companies are substantial if this cycle follows historical precedent rather than representing permanent structural change. Betting on cyclicals and commodities not being different this time has proven far more profitable over long periods than assuming fundamental breaks from historical patterns. The worst performers over a decade frequently become the best performers over the subsequent cycle, and small caps, with their operational flexibility and responsiveness to price signals, typically lead during recovery phases. What makes the current gold miner analogy particularly compelling isn't just the price appreciation, but the behavioral shift accompanying it. Companies previously castigated as capital destroyers are now issuing equity to expand operations, drill new prospects, and acquire additional assets. Markets that recently wouldn't provide them capital at any reasonable valuation are now funding growth initiatives. This perception shift from skepticism to enthusiasm, from capital going to die to capital going to thrive, follows cyclical patterns that are worth observing carefully. The fundamental case suggested by changing mining company behavior and investor willingness to fund expansion may be more instructive than the equity price move themselves. The comparison between the 2020 to 2022 mini-cycle following COVID and Ukraine invasion and the current precious metals re-rating is illuminating. The gold sector's transformation represents a genuine change in investability, a true revaluation of business models, and a wholesale shift in how the sector is perceived and approached by capital allocators. That transformation appears more durable and significant than the temporary enthusiasm that gripped energy equities during their brief moment of favor. Natural gas presents a different opportunity, set with less compelling asymmetry. Prices touched $5 briefly before settling closer to $4, with the forward curve reflecting similar expectations. Some upside exists toward a $5 mid-cycle equilibrium, but nothing comparable to oil's potential. Tier 2 and Tier 3 natural gas shale inventory becomes highly economic at $5, whereas oil prices could double without making lower quality locations attractive on a full-cycle basis. The demand story around LNG export facilities and data center development is real and substantial, but the supply response at modestly higher prices limits the upside compared to oil's more constrained production outlook. Investment approach in this environment requires focusing on companies with management teams demonstrating value creation across multiple entities and cycles, balance sheets capable of surviving commodity downturns, assets that generate substantial cash flow while attracting potential acquirers, and valuations heavily discounted to cash flow metrics, sale value, liquidation value, and replacement cost. The past decade taught humbling lessons about timing and the brutality of extended bear markets, but also validated the framework of buying quality at distressed prices even when the recovery takes longer than anticipated. Opportunities increasingly appear outside the United States and Canada in jurisdictions transitioning from hostile political environments toward more business-friendly governance. Alberta's experience moving from NDP control, effectively socialist by American standards, to a more industry-supportive administration provides a template. Finding ultra-cheap companies in regions poised for similar political shifts toward deregulation, lower taxes, and reduced regulatory burden has generated substantial returns. Not every international bet will succeed, but identifying situations where political risk is being overpriced relative to probable improvement creates attractive asymmetry. The danger in market analysis is extrapolating short-term narratives into permanent trends. What happened over 1 or 2 years rarely predicts the subsequent decade. Historical commodity cycles and equity performance through those cycles reveal patterns that current conditions are beginning to echo. Days when oil and gas indices drop 3 or 4% and individual names decline far more create both anxiety and opportunity to add positions at better prices. The discomfort is real, but so is the potential when sentiment eventually shifts and capital recognizes the value that fundamental analysis already sees. Looking backward at past energy cycles reveals how dramatically perception and valuation can swing. The worst performing sector over an extended period frequently becomes the best performer when the cycle turns. Multiple compression during bear markets creates the preconditions for expansion during recoveries, and small cap volatility amplifies both the pain and the eventual gains. We're not at peak production in any absolute sense. Vast resources remain in the ground. We may be approaching peak production at prices that prevailed through 2025, which is an entirely different statement with different implications for both commodity values and equity returns going forward.